In the alternate version of exercise 612, we're going to calculate days sales uncollected for Bargains Company for both 2015 and 2016 based on the information presented. We'll first move forward with calculating the ratio for 2015, and if you recall from the chapter, days sales uncollected is calculated by taking accounts receivable divided by net sales times 365 days. Item that I want to point out is that this is a net. So we take our overall gross sales, and if you recall from our prior chapters, and subtract out any sales returns and allowances and any sales discounts. That's an important point to make. So we'll take our accounts receivable of 61,000 divided by net sales of 669,000. Again, multiply it times 365 for the number of days in a year, and we arrive at 33.3 days. In the instructions, it points out to round the number of days to 1 decimal point, so that's why we have 33.3 days. If you also recall from the chapter that days sales uncollected is going to give us the average length of time or average amount of time it takes to typically turn its accounts receivable into cash. So it's a measure of liquidity, how much cash that we have available based on how quick we're able to turn our accounts receivable into cash. Now, does this mean that it always takes exactly 33.3 days? So every time we make a sale on account, that's the exact number of days that it's going to take? No, this is just an average amount of time. There may be customers that we collect more quickly from, say within 25 days. There may be some that are a bit more delinquent and troublesome to collect from in 45 days. But if we take all of those collections together, on average, it typically takes us about 33.3 days to collect our receivables. So let's go ahead and move forward with calculating 2016. Similar, exact same ratio that we have accounts receivable, but this time it's going to be 89,000 for 2016 divided by 749,000 in net sales for 2016 times 365 days equals 43.4 days for 2016. So let's think about, beyond calculating the number of days, what does this mean for the company? Well, in general, if we're going from 33.3 days in 2015 to 43.4 days, that's the increase in the number of days. For most companies, we would tend to say that this is probably not a good thing, because this is saying, hey, we have an increasing number of days. It's taking about 10 more days to collect our receivables into cash. For most companies, that isn't necessarily going to be a good thing. Typically, we want to be able to collect more quickly. Possible things that could have contributed to this slowdown. One could simply be not a result of the company itself, but maybe there's an economic downturn going on. It's just harder for companies in general to have cash available to pay their vendors. So that might have been a contribution to these additional 10 days. Another one could be perhaps related to the company itself. Maybe they decided to extend their credit terms. Maybe previously their credit terms were around 30 days. They normally extended their customers about 30 or maybe even 35 days. Now they've decided to get more in the 40 to 45 to 50 day range because they've determined that they want to be competitive with their competitors, that even though it takes maybe more days, they're actually able to sell more by extending the amount of times that they offer to their customers. So perhaps their amount of sales that they increase by may compensate for the additional days that it takes to make those collections. Another reason for the increase may be something perhaps negative on the company's perspective. Maybe their credit granting procedures and their collections efforts have taken a downturn. What I mean by that is maybe perhaps they're not reviewing the customers as much when they're extending credit, and they're extending credit to people who are slow paying or maybe not necessarily paying at all. Also, maybe they're just slacking off on sending reminders and sending statements to their customers. So it could be any one of those three items: an economic downturn, maybe an extension of credit in order to increase sales, or perhaps a downturn in our credit granting and collection procedures could contribute to that increase. Beyond just looking over time for the individual company, we also may want to do a comparison to the industry to make a determination of whether this is good or bad. For example, if the industry, perhaps in whatever industry that Bargains Company happens to operate in, if they typically offer customers maybe 50-day terms, meaning from the point of sale, usually they offer their customers 50 days to pay it off, then even though this is an increase, we're still well within the industry average. So maybe again, it's not necessarily a bad thing, even though that there was an increase. On the other hand, beyond an industry comparison, we should compare this to Bargain Company's own credit terms. For example, if Bargain Company typically offers its customers 45 days from the point of sales, its credit terms are net 45, meaning we give them 45 days from the point of sale, then again, even though there's an increase, we're still within those credit terms. So again, maybe it's not necessarily a bad thing. On the other hand, if the credit terms of this particular company are net 30, meaning we typically give our customers 30 days, then let alone 2015 were we beyond that, but now we're definitely well beyond that, almost 13 and a half days beyond that. So it would be definitely a bad sign for the company. So again, additional things, compare it to the industry and also compare it to the company's own credit terms.